I want to tell you something that most people in retirement have never been warned about. And I am not saying that to scare you or to create unnecessary panic. I am saying it because I have seen too many good, honest, hardworking people get blindsided by it. People who did absolutely nothing wrong, people who followed every rule they knew about, and yet they still ended up in situations that caused them enormous stress, confusion, and in some cases, real financial damage. If you have ever deposited a large chunk of cash into your bank account, if you have sold a car or a boat or a piece of property and received payment in cash, if you have received money from one of your adult children as a gift or to help you with expenses, if you have moved your own savings from one bank to another or consolidated accounts after a spouse passed away, there is a federal banking rule that could flag your transaction and potentially trigger scrutiny from government agencies. Not because you did anything wrong, not because you are suspicious, not because anyone thinks you are a criminal, but simply because of how the transaction looked on paper to an automated computer system that does not know you, does not know your history, and does not care about your intentions. And here's the worst part, the part that makes this situation so unfair and so dangerous. The people who get caught by this rule, the retirees who end up receiving letters from their banks or having their accounts frozen or being questioned by federal investigators, almost always had absolutely no idea that this rule even existed. They were not trying to break any laws. They were not trying to hide anything. They were just trying to deposit their own money they earned honestly through decades of hard work. And they made one small mistake in how they structured the transaction because someone gave them bad advice, or because they read something incorrect online, or because they were trying to be helpful and avoid paperwork. And that one mistake turned a completely innocent transaction into something that looked suspicious to federal banking regulators. Stick with me through this video because I am going to walk you through exactly how this federal banking rule works, why it exists, what triggers it, and most importantly, what mistakes retirees make that turn perfectly legal transactions into situations that attract unwanted attention from banks and government agencies. I am going to tell you about 3 specific real-world situations where this rule catches retirees completely off guard. And I am going to share a story about a retired teacher, a woman who did absolutely nothing wrong, who was just trying to organize her finances after her husband passed away, and who ended up in a nightmare situation that could have been easily avoided if someone had just explained these rules to her before she made a simple mistake. But first, before we get into the specific situations and the stories, let me explain the actual rule itself, the federal law that sits behind all of this, because once you understand what the rule is and why it exists, the whole thing will make sense and you will understand exactly what you need to do to protect yourself. Here is what is actually happening behind the scenes at your bank every single day, something most people have no idea about. Every time you make a large cash deposit into your bank account, your bank is required by federal law to file a report with the government anytime cash comes in over $10,000. This is called a currency transaction report, often abbreviated as CTR, and it is mandatory. The bank has no choice. They cannot decide whether or not to file it based on whether they think you are suspicious or trustworthy. If you deposit more than $10,000 in cash in a single transaction or in multiple transactions on the same day that add up to more than $10,000, the bank must file the report. They do it automatically. They do not call you to ask permission. They do not notify you that they are doing it. They just file the report electronically, and it goes to the Financial Crimes Enforcement Network, which is a bureau of the United States Treasury Department that tracks large cash movements as part of anti-money laundering and anti-terrorism financing efforts. Now, and I want to be really clear about this because this is the part that confuses people and causes unnecessary fear, that currency transaction report is not an accusation. It is not an investigation. It is not evidence that you did something wrong. It is just a record, a neutral documentation that a large cash transaction occurred. It means absolutely nothing on its own. Banks file millions of these reports every single year, and the overwhelming majority of them go absolutely nowhere. Nobody looks at them, nobody investigates them. They just sit in a database. So that part, the part about the bank filing a report when you deposit more than $10,000 in cash, that part you do not need to worry about. That part is completely fine and normal. If you sold something legitimately for cash and you deposit the full amount over $10,000, your bank files a report, and that is the end of it. There is no problem. Here is what you do need to worry about, and this is where people get into serious trouble without realizing it. At some point, somebody told somebody else, and then it spread like wildfire through communities and online forums and casual conversations, that if you keep your deposits under $10,000, you can avoid that report. The logic seems to make sense on the surface. If the threshold is $10,000 and if you do not want a report filed, then just deposit $9,000 or $9,500 or $9,800, or split the money into two separate deposits a few days apart, or have your spouse deposit half of it at a different branch, and then you will stay under the threshold and no report will be filed and you will not end up in any government database. And here is where it goes very badly wrong. That thing that people are doing to try to avoid trouble, that act of deliberately structuring your deposits to stay under the reporting threshold, that is the actual crime. It is called structuring, and it is a serious federal offense under United States banking law. And the brutal irony, the thing that makes this situation so unfair and so devastating to people who get caught, is that it does not matter one tiny bit whether the money itself is completely clean and legitimate. It does not matter if you earned every single dollar of it over 40 years of honest work. It does not matter if you can prove exactly where the money came from and that it was legally obtained. The moment you deliberately break up a transaction specifically to stay under that $10,000 reporting threshold, you have crossed a line that federal law takes very seriously. Structuring is itself a crime, regardless of whether the underlying money was legal or illegal. People have lost thousands of dollars over this. Some have had their bank accounts frozen while investigations are conducted. Some have had to hire expensive attorneys to defend themselves. And almost none of them thought they were doing anything wrong. They thought they were being careful. They thought they were protecting their privacy. They thought they were avoiding unnecessary paperwork. They had no idea they were committing a federal crime that could result in asset forfeiture, criminal charges, and penalties. So let me walk you through 3 specific situations where this actually comes up for retirees in the real world, real situations that happen all the time. And for each one, I will tell you exactly what trips people up, what mistakes they make, and what you should do instead to handle the transaction correctly and safely. First situation, one that probably happens thousands of times every single day across America. You have had a truck sitting in your driveway for 12 years. It is a good truck, well maintained, still runs great, but you do not need it anymore. Maybe you downsized to one vehicle. Maybe you are not doing the kind of projects that required a truck anymore. Whatever the reason, you decide to sell it. You list it online or put a sign in the window or mention it to a friend, and someone comes along and wants to buy it. Private sale, cash deal, the way these things often happen. The buyer hands you $11,000 in cash, you shake hands, you sign over the title, the truck drives away, you go straight to the bank and deposit the $11,000 in cash into your checking account. Your bank files a currency transaction report because the deposit was over $10,000. Your name goes on a federal record. And I know that sounds alarming. I know it sounds scary to think about your name being in a government database, but it is genuinely fine. You did nothing wrong. The report is just a record of a large cash transaction. It has no teeth on its own. Nobody is going to investigate you. Nobody is going to question you. It is just a piece of paperwork that gets filed and forgotten about. The problem comes later. You go home, you think about the situation. Maybe you feel a little uncomfortable about having had a report filed on you. Maybe you mention it to a friend or a neighbor or someone at church, and that person says to you, oh, you should have kept it under $10,000. If you had just deposited $9,500 instead of the full $11,000, they would not have reported it. And next time you have cash to deposit, you should split it up. Deposit $8,000 this week and $3,000 next week, just to keep things simple and avoid having reports filed on you. That advice sounds helpful. It sounds reasonable, but that is the mistake. That is what turns a perfectly clean, perfectly legal transaction into something that investigators actually look at, and that can get you into serious trouble. If you take that $11,000 from the truck sale and instead of depositing it all at once, you deposit $9,000 today and then come back 3 days later and deposit the remaining $2,000, you have just committed structuring. You deliberately broke up the transaction to avoid the reporting threshold. And the banks have sophisticated software that detects exactly this kind of pattern. When you make two deposits within a short period of time that together add up to more than $10,000, but individually are below $10,000, red flags go up. The bank will likely file a suspicious activity report, which is much more serious than a currency transaction report, and you may end up with far more scrutiny and far more problems than if you had just deposited the full amount in the first place. What you should do instead is simple and straightforward. Just deposit the entire $11,000 all at once, the whole amount. Yes, a currency transaction report gets filed. That is fine. That is normal. That is how the system is supposed to work. What protects you is not avoiding the report. What protects you is having the paperwork that explains the transaction. Keep the bill of sale from the truck. Keep the title transfer documents that show you sold the vehicle and transferred ownership. Keep your deposit receipt from the bank. If anyone ever asks you anything, which they almost certainly will not, you have got your answer right there on paper. You sold your truck for cash. You deposited the proceeds. Here are all the documents proving it was a legitimate transaction. End of story. Second situation, one that happens in families all the time and that causes enormous confusion and potential legal problems. Your son wants to give you money. Maybe he sold his business and wants to share the windfall with you. Maybe he just wants to help out because he knows you are on a fixed income. Maybe he feels guilty that he has not been able to help you much in the past. Whatever the reason, he wants to give you a significant amount of cash, or your daughter gives you $15,000 to help with medical bills that your insurance did not cover, or your grandchildren pool their money together and give you a gift for your birthday or an anniversary. These are completely legal transactions. A gift is a gift. It is not income. You do not owe taxes on it as the person receiving it. There is nothing wrong with family members helping each other financially. But here is what happens in almost every single family when this situation comes up. Everyone starts trying to be helpful. Your son says, "Let me send it to you in a few smaller wire transfers so the bank does not make a big deal out of it." Your daughter says, "Just deposit a little at a time over a few weeks so you do not trigger anything." Your spouse says, "Why do not I put half of it in my account and half in your account so each deposit is smaller?" Everyone has ideas about how to make it easier, how to avoid hassle, how to stay under the radar. I understand completely why it feels like the right move. Nobody wants hassle. Nobody wants to deal with paperwork. Nobody wants to feel like they are being watched or monitored. But every single one of those ideas, every single one of those well-intentioned suggestions is structuring, and it does not just expose you to legal risk. It can expose the whole family. If your son sends you 5 separate wire transfers of $3,000 each instead of one transfer of $15,000, and if someone later looks at those transactions and questions why they were broken up that way, your son could face structuring charges. If you deposit cash gifts in small increments deliberately to stay under $10,000, you could face charges. The law does not care that everyone involved had good intentions and that the money was completely legitimate. What you actually do, what you must do to stay safe and legal, is deposit the gift in full, all of it at once in one transaction. If it is a wire transfer or a check, there is already a clean paper trail built into the transaction and you are basically done. The bank can see exactly where the money came from, when it was sent, who sent it, and there is nothing suspicious about it. If it is cash, you go to the bank, and if the teller asks about the source of the funds, which they might, you tell them truthfully and simply that it is a family gift. Then you deposit the whole amount. The one additional thing you want to have on file is what is called a gift letter. Do not overthink this. It does not need to be drafted by a lawyer. It does not need to be notarized. It does not need to be on fancy letterhead. It is just a simple piece of paper signed and dated by the person who gave you the money that says something like, I, your son's name, gave my mother your name, the amount of $15,000 as a personal gift on this date for the purpose of helping with medical expenses. This is a gift with no expectation of repayment. That is it. That letter plus your deposit receipt, and you are completely covered. If anyone ever questions the transaction, you have immediate documentary proof of exactly what it was and where it came from. Now, the third situation, and this is the one I really want you to pay close attention to because it is the one that catches the most retirees by surprise and causes the most heartbreak because it involves people who are literally just moving their own money and who end up in terrible situations through no fault of their own. Before I get into the details of how this works, let me tell you about the retired teacher I mentioned at the very beginning of this video, because her story illustrates perfectly how innocent people get caught in this trap. She was 69 years old, widowed, living alone. Her husband had passed away a few months earlier after a long illness, and she was trying to get her financial affairs organized during one of the most difficult and emotionally exhausting periods of her life. She and her husband had been together for over 40 years, and during that time, they had accumulated accounts at 2 different banks. Some of the accounts were joint accounts in both names. Some were individual accounts in one name or the other. There was a checking account at one bank, a savings account at another, a certificate of deposit at the first bank that had been opened decades ago, and a money market account at the second bank. Over the course of their marriage, they had saved diligently and carefully, living modestly, putting away money whenever they could. And by the time her husband passed away, they had accumulated a reasonable nest egg, nothing extravagant, but enough to give her some security in her retirement years. After the funeral and after dealing with the immediate aftermath of her husband's death, she decided that she wanted to simplify her financial life. She did not want to deal with accounts scattered across multiple banks. She did not want to keep track of different statements and different passwords and different customer service phone numbers. She just wanted everything in one place where she could see it easily and manage it without constant stress. So she made a plan to move all of the money from the accounts at one bank into her primary checking account at the other bank, consolidating everything so she would only have to deal with one financial institution going forward. And here is where things went wrong, not because she did anything dishonest, not because she had any bad intentions, but simply because she was exhausted, grieving, overwhelmed, and trying to avoid what she thought would be complicated bureaucracy. Instead of moving all the money in one large transaction, she moved it in smaller chunks over a period of a few weeks. She withdrew $9,000 from one account and deposited it into her primary checking account. A week later, she withdrew $8,000 from another account and deposited that. A few days after that, she cashed in a certificate of deposit and deposited $7,500. She was not trying to hide anything. She was not trying to avoid taxes or dodge reporting requirements. She simply thought that moving smaller amounts would be easier, would require less paperwork, would be less hassle at a time when she could barely handle any additional stress. 6 weeks later, she received a letter from her bank asking her to come in and explain the transaction pattern. The letter was formal, cold, bureaucratic, and it scared her terribly. She had no idea what she had done wrong. She called the bank in a panic and was told that the pattern of her deposits had triggered a review and that she needed to provide documentation explaining where the money came from and why she had deposited it in multiple transactions under $10,000. She tried to explain that it was all her own money, that she was just consolidating accounts after her husband died, that she had not done anything wrong. But the bank representative was not sympathetic or helpful. They told her that the matter had been referred to their compliance department and that she would need to provide extensive documentation. She ended up having to hire an attorney, which cost her several $1,000s. She had to gather bank statements going back years. She had to provide death certificates, probate documents, tax returns, and written explanations of every transaction. The entire process took months and caused her enormous stress and anxiety at a time when she was already dealing with the grief of losing her husband. And the truly awful part of this story is that she never actually did anything illegal. She never committed a crime. She was not charged with anything, but the pattern of her deposits, multiple transactions, just under $10,000 occurring over a short period of time, looked exactly like what someone trying to avoid reporting requirements would do. The bank's automated software flagged it. Their compliance department investigated it, and she got caught up in a bureaucratic nightmare simply because no one had ever explained to her how this rule worked. That is the situation that nobody prepares you for. Moving your own money between your own accounts. No sale involved, no gift involved, no outside party, just consolidating your own savings. And it still triggered a review because of how it looked to an automated computer system that has no context, no understanding of your personal situation, no ability to see that you are a 69-year-old widow who just lost her husband and is trying to simplify her life. The bank's software does not know you just lost your husband. It does not know you are 69 years old. It does not know you have been saving honestly your entire adult life and paying taxes on every dollar. It sees a pattern of transactions that all land under $10,000, repeated multiple times over a short period, coming from multiple source accounts, and it flags it as suspicious. That is it. No judgment, no context, no human review at the initial stage, just an algorithm doing what it was programmed to do. So what should you do when you need to move a large amount of money between your own accounts, whether because you are consolidating after a spouse dies, or because you are switching banks for better interest rates, or because you want to close accounts you are not using anymore? Move the money in one transaction, one wire transfer or one cashier's check or one electronic transfer, clean and done. If you are moving $30,000 from bank A to bank B, do not make 3 deposits of $10,000 each or 6 deposits of $5,000 each. Make one transfer of $30,000. Yes, if it is cash over $10,000, a currency transaction report gets filed. That is fine. That is normal. That is legal. When the bank teller asks you where the funds are coming from, and they might, your answer is simple and straightforward and brief. These are my personal savings being transferred from my account at the other bank. One sentence. Do not elaborate. Do not volunteer extra information. Do not start explaining your whole life story. Just answer the question that was asked with a simple, truthful, direct response. What you keep on file to protect yourself. A bank statement from the account you are moving the money out of, showing the balance before the transfer, your wire confirmation or cashier's check receipt showing the transfer, and if the money came from a certificate of deposit that matured or an account that was closed, keep that account closure notice or maturity notice. It takes you maybe 5 minutes to save these documents and put them in a file folder, and they protect you indefinitely. If anyone ever asks you about that transaction, you have immediate written proof of exactly what happened and why. All right, now let me talk about what actually keeps you safe in all of these situations, because I want to explain each piece of this in detail rather than just giving you a checklist that you will forget about as soon as this video ends. The first thing that keeps you safe is having some kind of contemporaneous document that explains where the money came from and why it moved when it did. A bill of sale if you sold something, a gift letter if someone gave you money, a transfer record or account statement if you moved your own money between your own accounts. Without this kind of documentation, you are just a person who deposited a large amount of cash, and you have a verbal explanation that may or may not be believed. With this documentation, you have a paper answer that closes the conversation immediately. Someone asks you where the money came from, you hand them a document, conversation over. The second thing that protects you is having a bank statement from the source account showing where the money was before it moved to your account. The first question that anyone investigating a large deposit will ask is, where did this money come from before it arrived in this account? If your answer is a document instead of a story, If you can hand someone a bank statement showing that this money was sitting in your savings account at another bank for the past 5 years, you are in a completely different position than if you just say, it was my savings, with nothing to back it up. Documents are more powerful than words. Third thing is keeping your transfer confirmation, wire receipt, cashier's check stub, electronic transfer confirmation, whatever form the transaction took. It takes 30 seconds to download it or save it or request a copy from the bank. Keep it for at least 3 years, ideally longer. These confirmations show the date, the amount, the source, the destination, and they prove that the transaction happened the way you say it happened. Fourth thing, and this is important for transactions that might have tax implications, make sure that your tax return tells the same story your bank records tell. If you sold something for cash and deposited it, that sale might need to show up on your tax return depending on what you sold and for how much. If you sold a car for a gain, that might be taxable. If you sold property, that is definitely reportable. When your tax return and your bank records tell the same consistent story, there is nothing for anyone to investigate or question. When they tell different stories, when money shows up in your bank account but nowhere on your tax return, that raises red flags. And fifth, this is critically important. If you ever receive a question from your bank or from any government agency about a transaction, answer it once, clearly and completely, with your documents in front of you. Do not over-explain. Do not call back the next day with additional information you forgot to mention. Do not get nervous and start adding details that were not asked for. One clear answer backed by paper documentation. If the situation ever goes further than a routine bank inquiry, if you receive a letter from the IRS or from any law enforcement agency, stop talking immediately and call a CPA or a tax attorney before you say anything else to anyone. Do not try to handle it yourself. Do not think you can talk your way out of it. Get professional legal help. Let me deal with a few things I hear people say constantly that are just flat out wrong, because any one of these misconceptions could cause you real problems if you act on them. First misconception, if I keep my deposits just under $10,000, I am safe and I will not have any problems. This is completely backwards. You are not safe. You are actually in more trouble than if you had just deposited the full amount. Deposits of exactly $9,900 or $9,800 or $9,500, these are among the most flagged deposit amounts there are. Banks are not just watching for deposits over $10,000. They are specifically watching for patterns of people trying to stay below $10,000. Repeated deposits that all happen to conveniently land just under the reporting threshold look exactly like what someone who knows about the rule and is deliberately trying to dodge it would do. If your actual amount is $11,000, just deposit the entire $11,000. If your amount is $14,000, deposit all $14,000. The report gets filed, and that is fine. That is legal. That is how the system is supposed to work. Second misconception, this only happens to people who did something shady or illegal. It does not. The system is automated. It does not look at your personal history, your character, your reputation, or your intentions before it flags something. It sees a pattern that matches certain criteria, and it automatically fires off a report or triggers a review. Plenty of completely honest retirees with perfectly clean money, people who have never broken a law in their lives, have received letters and been questioned because a transaction pattern looked suspicious to a computer algorithm. That is the whole reason I am making this video. This is not a problem that only affects criminals. It affects regular people who made innocent mistakes. Third misconception, I am retired, I am 75 years old, I am on Social Security and a fixed income. The IRS and the banks are not interested in me. There is no age exemption from these rules. There is no retirement exemption. There is no fixed income exemption. The exact same currency transaction report gets filed on a 72-year-old retiree depositing cash as on a 35-year-old business owner depositing cash. Your age does not protect you. Your employment status does not protect you. Your good intentions do not protect you. What protects you is understanding the rules and following them correctly and having the documentation that proves your transactions were legitimate. Here is what I actually want you to walk away with today, the core message that matters more than any of the specific details. This federal banking rule, the requirement that banks report large cash transactions and the prohibition against structuring transactions to avoid reporting, exists to catch money laundering, drug trafficking proceeds, terrorism financing, and other serious financial crimes. It was never intended to be a trap for retired people who sold their truck or who received a gift from their adult children or who moved their savings after a spouse died. These rules were not created to target you, but the trap catches people anyway, not because they are criminals, not because they have bad intentions, but because they received bad advice or no advice at all, and they structured a transaction in a way that looked suspicious without realizing what they were doing. But you are not in that group anymore. After watching this video, you know what the rule is, you know what triggers it, you know what mistakes people make, you know what documentation to keep, and you know the one thing that actually causes serious problems: deliberately breaking up a deposit or withdrawal to stay under the reporting threshold. That is the crime. That is what gets people into trouble. Everything else is fine. Deposit your money in full, keep your paperwork. Answer questions honestly and briefly if anyone asks. That is genuinely all there is to it. Before you go, I want you to drop a comment below and tell me what state you live in and what kind of transaction you deal with most often. Do you sell property or vehicles frequently? Do you receive family gifts of cash? Do you move money between accounts regularly? I read every single comment, and whatever topic comes up most frequently in the comments is what I will make my next video about. So if your situation is a little more complicated than what I covered today, or if you are not sure how these rules apply to your specific circumstances, put it down there in the comments. Your question might end up being exactly what someone else needed to hear too, and I can address it in detail in a future video. Thank you for watching, and I will see you in the next one.